In this week's video, we'll use hard data and charts to answer the question, what is the observable evidence telling us now? In last week's video, we used these charts to say there weren't many similarities to 2008 and the present day. This is the early stages of a bear market. What about a correction? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. With central banks playing what seems to be a larger and larger role in the financial markets, a flash crash type event is something that we could potentially see. Do we see similarities today to 2010? So what we're looking at here is bonds relative to stocks. This is the ratio here where the cursor is. This is the S&P 500 weekly here for reference purposes only. Point of the exercise, we like to use observable evidence over forecasting. The first observable changes that took place with this ratio is price above blue, and blue turns up here right around the 19th. Look how early in the process we start to see changes. We can see these changes before the stock market drops. You can see here we have a full bore bullish look very early in the flash crash correction period here in favor of TLT. So this is a risk off look here, and then stocks fell. How does this compare to the present day? This is the same ratio using the same moving averages as of 3:15 p.m. on Friday, December 5th. You can see we really don't have anything here that looks similar to the early stages of a correction. Price is below blue, blue is below red, and the slopes of both of them are down. This doesn't tell us anything about what will happen next week, but it does tell us that the odds are more favorable for stocks here than they were here. We'll be using the exact same concepts here, so we'll move quickly. Now we have the VIX risk off, or the VXX ETF in this case, relative to stocks. Same concepts apply. This is the flash crash period here. This is a weekly chart, so this is a lengthy decline in the stock market. Observable changes here. Blue turns up, price is above blue, and you can see that's very early in the process. This is what a low probability looks like for the stock market today as of December 5th at 3:19. This looks nothing like this. Regular viewers know this weekly S&P 500 chart from an observable evidence perspective. This is observable here when momentum drops out of overbought territory. The probability of bad things happening after this increases. You can see as of December 5th, right before the close, 3:57 p.m., this looks good. In fact, this line is rising again. How does that compare to the flash crash period? Emphasizing the concept of observable evidence and patience over forecasting. This is 2010, same basic chart as this chart on the left. Here you can see we dropped out of overbought territory, so this really doesn't look anything like this. Was this helpful during the flash crash period? The answer is yes. We can see this here. Then the S&P 500 drops for 2.5 months after we can see this. This looks good. Doesn't tell us much about what will happen next week, other than we're not in a low probability profile like we were here. The odds are more favorable as we sit in the present day. Weekly momentum can give us observable clues in the bearish and bullish direction. We're looking at the IWM, or small cap ETF here. You can see when momentum is in oversold territory and then moves back clearly into overbought territory. After that, on the weekly chart, good things happen. Clearly oversold, move into overbought, observable. After that, on the weekly chart, good things happen. Oversold, move into overbought, good things happen. Recently, we moved into oversold. We've moved back into overbought. And this week, momentum improved. So right now, this chart looks pretty good. We also have a bullish moving average crossover, and we broke above this downward sloping trend channel on the weekly small cap chart. We'll scroll through a few charts here using the October low to illustrate the concept of remaining flexible and unbiased and looking at observable evidence rather than forecasting. When the S&P 500 was down here, it was reasonable to assume that it might rally and then make a lower low. The stock market is a very difficult place. We did not make a lower low, and that was a reasonable assumption. Rather than making a lower low, we rallied further. Since this was such a sharp V bottom, forecasting or human nature may have told us we'll just be patient and wait for a little bit of a pullback here, and then we'll start scaling in. As the evidence continued to improve, the stock market continued its trend of making it difficult. It never did pull back. We got a very unusual and rare V bottom here. We did start to get a little bit of a pullback here, and then what we can do as human beings is we say, well, here finally we have the correction. I'll be patient and I'll buy back in somewhere down here. Once again, the market was able to regain its footing, and rather than correcting, it rallied again. Purpose of the exercise is to show how difficult it is to forecast, especially when our egos and emotions are involved. As always, we'll head into next week with an open and flexible mind, but from a price perspective and an observable evidence perspective, it's very, very difficult to be too bearish at this point. S&P 500 was up almost 8 points this week, and it made a new weekly closing high. On Friday, it also made a new daily high. If we're going to have a correction or a bear market, that has to start at some point with a lower high and a lower low. So the bears, while they may take control next week, have some work to do. So these are not high-risk profile charts as they sit now. These are weekly charts as of the close on Friday, December 5th. This is a lower probability look here with price below both moving averages, blue below red, and the slopes of both moving averages are down. This is a full-bore bullish look here, price above both moving averages. Blue is above red, and the slopes of both are up. We still have a full-bore bullish look. There's very little to be concerned about as this chart sits now. Similar concepts with Dow long versus short. Would I rather be long? Would I rather be short? DIA relative to DOG also has a full-bore bullish look as of the close on Friday, December 5th. This is stocks, the S&P 500 weekly relative to intermediate term treasuries. It also has a full-bore bullish look in favor of stocks over treasuries. You can see we broke above this downward sloping red channel here. We hit resistance here, resistance here, resistance here. This week we were able to break above that resistance. What once was resistance may now act as support heading into next week. As always, we'll keep a flexible and open mind. These are American Association of Individual Investor poll results for this week. The percent of the respondents that are bullish is fairly high at 42.7%. Sentiment is a contrary indicator. Think of it this way. If you get to the peak during the dot-com bubble. So let's say it's January to March of 2000. Almost everybody is fully invested. And when you're fully invested, you must be bullish because you expect stocks to go up. And then you run out of buying power or buying conviction. So at extremes, this can be a contrary indicator. Where do we sit now? Or to phrase the question another way, are we at an extreme level now? According to AAII, we are in a normal range right now. Readings between 23.8 and 49.3 are within the normal range over the historical results. So this is not an extreme reading yet. It's relatively high, but it's not extreme. What do they consider to be extreme in terms of historical results? 59.8 would be an extraordinarily high number. How high could this get? The all-time record is 75, set in January of 2000. This data here helps us understand the importance of looking at the weight of the evidence rather than any chart, ratio, or indicator or piece of data in isolation. The weight of the evidence speaks to probabilities. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.